Well, the cost of borrowing is expected to go up again today.
Yeah, we'll find out in just over an hour and a half or so. Bank of Canada will make its final interest rate decision of the year. Experts appear split on whether the central bank will opt for another hike of a quarter point or a half percentage point. They'll also be watching the bank's language coming up at 10 o'clock this morning. They'll be listening closely to see if Tiff Macklem signals any end to interest rate hikes.
Ian Lee, Associate Professor at Sprott School of Business, joins us live now to talk more about this. Ian, what do you expect to hear today from the Bank of Canada?
I think he's going to first he's going to announce a rate increase. Let's be very clear about that. He's been telegraphing this or sending signals that this is going to happen. Consensus is half of 1 point. Some are saying a minority view is a quarter of a point. Some are saying 3/4. I think it'll be about a half point. He's going to say that there's light at the end of the tunnel. That is to say that inflation is going to abate or decline in 2023, but they have to keep up the pressure on cooling the economy to reduce the too much demand chasing too few goods. I think that's going to be the message today.
So much of this has also really had an impact, of course, on the housing market in particular, Professor. We've seen housing sales drop, significantly. We've seen housing prices come down and, of course, mortgage rates going up. So much of our sort of economy seems to tick and evolve around the housing market. So do you think this may signal, though, the end of the hikes based on the impact it's had?
Mm-hmm.
I don't, because yes, it has had an impact on the housing market. I've never denied that. I have consistently argued that pundits and even some of our regulators don't understand that it does not drive millions of people into foreclosure. We have statistics going back 80 years in our country of high interest rates. I was a mortgage manager in 1980, and the rates went to 20%, and the delinquency ratio went from 1/2 of 1 point to 1 point. In other words, 99% of Canadians continued to pay their mortgage on time. You're correct. The increased rate has an impact on housing by reducing the average house price, but it doesn't drive massive increases in delinquency.
And Ian, Equifax released a report this week pointing to an increase in non-mortgage debt and Canadians leaning on credit cards to pay their bills. What do you think a hike today will mean to Canadians in that financial shape?
Jennifer, you've asked the real question that I wished more pundits and regulators would talk about. I'm not suggesting interest rate increases don't have an impact. I'm saying the last place you'll see the impact is on mortgage foreclosures. What you do see when rates go up is an increase in credit card delinquency. You see an increase in utility payment delinquency, your electricity bill, your gas bill, because Canadians are rational consumers. They understand if you don't pay your credit card, you're not going to end up in a snowbank in January at -25. Stop paying your mortgage payment and you'll be out in the snowbank. And so the last thing, and the data is very clear on this, you default on your unsecured loans first, you default on your credit cards first, you see delinquency go up, but the one thing you don't default on is your mortgage payment, which is why mortgage rates are so incredibly low. Right now as we speak, 0.2% of 1% are delinquent, meaning 99.8% of Canadians are current.
Professor, I love the perspective we're bringing this morning, indeed, but you mentioned in your earlier answer that you kind of feel like we're going to see some rates maybe increase into next year from the Bank of Canada. Long term, or maybe even next year, do you think they will stop going up next year and start to come down, or just kind of hit pause?
My own, and I read every morsel, every word that comes out of the Bank of Canada and their speeches and their reports. I think they're going to go up a bit more in 2023. They'll probably peak in the first half of 23 and then stabilize while they're waiting to see if inflation really is declining as they are forecasting. And then I think we'll start to see rates come down in 2024 once the bank is confident, the central bank is confident that inflation really is been squeezed out of the system and is going to return to its long-term rate of around 2%. So I think we'll see a little bit more interest rate increases early 2023, earlier part, and then it'll go flatline interest rates, and then we'll see interest rate declines in 2024 as inflation declines.
A lot to watch for. Ian Lee, Associate Professor at the Sprott School of Business. Appreciate your time. Thank you.
Thank you.
My pleasure. Thank you.